to you for some more insight on particular sectors there, but at this stage I understand that Mayuresh Joshi, who's fund manager, Angel Broking, is joining us right now. Mayuresh, wonderful to have you here on the show with us. Give us a sense as to how you're looking at the kind of consolidation that we're looking at, as well as, I guess, some of the kind of spikes we've seen in the markets.
Afternoon, Fatima. I think it's always a pleasure to be on your show. So a large element in terms of what Piyush mentioned, I think all these key variables are probably playing out on the markets at this point of time. And the initial set of results that we've probably seen, a few of the large private sector banks, specifically the retail-oriented ones, have given a very good set of numbers. Large IT companies have given a good set of numbers along with the mid-cap peers, who in my opinion have probably outperformed the market in terms of their guidance going ahead. A few of the consumption-driven stocks, what you probably saw in terms of results that came over the weekend, I think that is probably lending a strong amount of confidence in the markets in terms of if the monsoons are probably better or in average to what the estimates have got laid out, you're probably going to see a very strong rural recovery in the second half of this fiscal, aided by the front loading of the government capex over the next few months. Is going to have a huge push through in terms of not just the cyclicality in terms of demand picking up at the FMCG and the staples end, but even infrastructure in terms of road projects given out, power projects given out, are going to see a significant increase in trend, which will drive the private capex over the next few quarters, hopefully by Q3, Q4 of this fiscal. A large element in terms of the outside risks of what probably happens with the crude prices. The markets have largely gestated that with the belief that the run-up in crude from the current levels would not be substantial enough with shale inventories coming through. And the yield movement that you've probably seen both on the domestic market as well as the global market, assuming the fears that one sees with the spike in crude and inflationary pressures, I think to a large bit the markets have gestated that as well. So again, I think consolidation was the key theme that you're probably playing out at this point of time. But it's going to be more stock-specific approach. And if the results, as the results have been going so far, barring a few of the PSU banks, which might have struggled to do with in terms of provisioning, I think a large element in terms of results, ex-PSU banks, ex-oil and gas, I think the results should be quite stable this quarter around. And if that is a testimony to the results improving and our own assumptions over the next 2 years of 14-15% earnings growth, you're probably going to see a lot more activity happening in sectors like consumption, infrastructure, cement, auto ancillaries.
All right. That, of course, is a good way to look at the overall picture. But, Mayuresh, I'm going to ask you to hold on because we're getting some more news on this. Mayuresh, how are you tracking Fortis at this stage, and what do you think of the latest developments?
So, Fatima, I think it has covered it very, very comprehensively. What is probably happening to and fro in terms of bids getting revised, new bids coming probably on offer at this point of time, and the board consideration for the best bid that will probably come through. I think let's wait for all these processes, because I think the to and fro probably has a lot of bearing in terms of the volatility in terms of the price. Second, in terms of the core fundamentals itself, I think the industry is looking attractively poised at this point of time, both in terms of the operational beds, the expectations of the organized sector actually doing well because of the lifestyle diseases that one is witnessing over the past few quarters and years, and again medical tourism. So again, I think the key attributes that one probably looks at in terms of the average operating revenue per bed, the turnaround time, how much utilization levels or the occupancy levels of your total bed strength has been. Again, I think it's an industry that I'll probably like, but for Fortis in particular, I think let the developments probably take place. And even if one pegs the fair value that a lot of these suitors have put in place, I think it's very close to where the market price is at this point of time. So I think I'm not taking a premature call in terms of Fortis, but what I really like within this sector would still continue to be Apollo Hospital. Though richly priced, I think there is sufficient enough confidence that I've probably got in the industry dynamics itself, which should lead to a significant amount of earnings accretion for select few stocks within this space.
Sure, and governance and ethics are definitely something that are being, and rightly so, once again very much highlighted when it comes to really realizing true value of companies. Hold on, Mayuresh, stock has been reacting. Mayuresh, your call on this particular counter as well as the sector?
No, so for the sector as a whole, Fatima, I think the call remains the same. I think what really needs to be stock specific here because of all the concerns that the US FDA has posed towards the sector. So I think remediation costs are pretty high and those costs will remain pretty high. The second element in terms of a lot of generics probably getting approval even through their approved ANDA pipeline for a lot of these companies basically means that the pricing pressure still continues. And the third element in terms of elevated R&D cost because you need to create a specialty special molecule pipeline. I think that obviously has a say and bearing in terms of your margins. So all these three factors have resulted in earnings downgrades for a lot of pharma companies. I think the hinge or the hinging factor rather for these companies is the resolution for the US FDA affected plants which are there for a majority of these players selectively. And that probably gives it some amount of respite that if these resolutions do come through over the next few quarters, FY 19-20 earnings will be relatively better than what you probably witnessed. For Cipla in particular, I think what Hiral was mentioning in terms of these two small drugs, probably in terms of the potential market size that they can garner and the revenue potential that they can address. A large element of them coming through the core plant is a big plus. The second element in terms of their combination inhaler product, which probably is something that a lot of analysts are waiting for to hit the UK markets, that has a huge potential as well. And the kind of launches that they've done in the quarter gone by and the approvals that they've received, I think gives it some amount of confidence that they'll be probably able to maintain a steady earnings growth. So I think a clear hold on Cipla, at least at this point of time from our end. But what we really like on declines at this level or at this stage of the markets would be Ipca Labs, where the domestic formulation business is looking extremely strong. You're probably going to see some amount of a reaction in terms of what happens in terms of the tenders that get floated specifically from United Nations or the other organizations towards the malarial products. And the third element in terms of any resolution of their three key plants that have got affected by US FDA over the last 3 to 4 years and where they have confidently gone ahead and done a huge amount of remediation. If any positive note through comes over the next few quarters, that does push the consolidated SOTP valuations for Ipca. So any significant decline on stocks like Ipca is something that I'll continue to prefer. Lupin, Cipla from the large caps are a clear hold from my side.
Okay, Mayuresh, lots to, of course, get through on this particular day because we've also had some policy announcements that are coming out and playing out in the stocks. Specifically, just want to bring up the sugar stocks for you right now because this is playing out like a boost for sugar companies. The cabinet has approved the subsidies for sugar mills. In fact, we're looking at specific numbers, and that production subsidy is supposed to help those farmers. And of course, there's an entire sort of mechanism behind it. But just want to bring up some of those sugar stocks for our viewers right there. Look at that. You can see Dhampur as well as Balrampur and Uttam, the stocks coming up for you right there as well. Dhampur sugar, in fact, now you're looking at a bit of a dip, but Balrampur Chini as well as Uttam sugar slightly marginally up, as well as other stocks as well. So that, of course, was a bit of a policy announcement. Mayuresh, we've talked about sugar earlier, but anything you have to say about this particular sector?
For the sector as a whole, again, I think if one really looks at the ISMA estimates, you're probably looking at pegging the overall production anywhere between 31.5 million tons. If you look at the potential demand scenario in India at this point of time, it's anywhere between 24 and a half, stretch that up to 25 odd. So you've got a carryover inventory of the last sugar season, plus even if one accounts for some amount of exports that these companies may be able to do, which I really doubt, because if you look at the export subsidy that a lot of neighboring countries have given, the glut in sugar production probably in terms of the supply dynamics internationally and the fall in sugar prices even on international bourses, I think you're probably not going to get the due realization that one is really hoping for. So the second element is obviously the excess carryover inventory that you probably carry on in the next sugar season. So it's a typical 2-year on-off cycle that one really looks at. You're probably seeing because of elections and political compulsions, that the SAP and the FRP price is still being elevated, which means that a lot of production numbers that we've probably seen can get extended into the second half of the next fiscal as well, which means the next sugar season as well. And that probably is not an encouraging sign from a sugar producer perspective, who gets hit on two counts. I think the cane areas which have actually hit 19,000 crores and may burgeon if these prices are elevated even further is an outside risk. And the other element obviously is the core sugar realizations, which have dipped significantly. So the kind of leverage that these companies enjoyed during the off cycle during the sugar season, I think they're clearly not enjoying that, which means that the operating leverage benefit will not come through. The subsidy is kind of a set-off effect in terms of the hit that they might take on the P&L, but it's just a temporary relief. The cash flows, in my opinion, are not going to improve for a majority of the sugar companies, whether they are operating out of UP, Maharashtra, AP, that really doesn't matter. So I think staying away from this sector because the cycle is not in their favor.
Right, the cycle's not in his favor, and it's a pretty tough trajectory despite the latest developments that we're looking at. Going back to my guest, Mayuresh, if you want to sort of talk to us about what you're seeing on Kotak, but what I also wanted you to tell me about was your reaction to what we saw coming out of an HCL Tech, because we're running out of time. I need your quick take for the investors that are looking at us. What are you thinking when you saw the kind of, when you're looking at those numbers?
So Kotak was quite stupendous in terms of the loan growth, as Shail mentioned. I think a 23-24% credit growth, exemplary. Overall stress assets around 2.2-2.3%, which is below the 2.5% mark. Credit costs around 72 odd bips. And you probably looked at the franchise, the liability franchise in terms of SA, actually grew at a huge pace, which took CASA about 50 odd percent. And the life insurance business, I think the pegged embedded value in excess of 5,800 odd crores with VNB margins of 29 odd percent, obviously has given Kotak a fresh lease of life in terms of having larger than life valuations on a price to book parameter. So I think we like this counter at lower levels. I think the whole recommendation still continues. On HCL Tech in particular, again, I think the organic guidance that they probably gave of 5-6%, a tad bit below NASSCOM estimates of 7-8%, and that's what probably has irked the street in terms of how they'll probably able to organically grow their business. On the other hand, I think the margin maintenance of around 19.5 to 20.5, I think that's quite stable and in line with estimates. The revenue, bottom line in estimates, but again, the guidance specifically in terms of the organic growth is what has probably put up the street a tad bit. But again, I think the inorganic acquisitions have been pretty stable for HCL Tech, and they're still maintaining that overall they should be able to grow anywhere between 9.5 to 10.5%, which is again quite commendable, with expectations of IMS actually bottoming out of the next 2 to 3 quarters, and engineering services actually expected to pick up steam with digital investments and transformational deal wins expected to gain momentum. So I think the stock had run up significantly. With this, I think some money and profit booking was taken off the table. But I think within the large cap names, I think our whole recommendation on HCL Tech still continues.
All right. Thanks for taking us through all of that. In fact, we are going to be having a conversation coming up with that particular company later on in the show.